Welcome to our exclusive monthly update on the Indian economy for February 2024. In this video, we will provide a comprehensive analysis of the latest economic developments, including insights into inflation, GDP performance, and the impact of key policy decisions, interim budget, etc. Stay informed about the evolving economic landscape and the government's vision for a developed India. Don't miss out on the critical factors shaping India's economic health announced during this month. Subscribe now to stay ahead of the curve and gain a deeper understanding of the economic dynamics at play in India. Please like and share this video. Your support is extremely valuable to us. Let's talk about CPI. First, let us look at an area which is relevant to all of us. Inflation in the country. Is it going up or coming down? In January 2023, the CPI inflation for rural and urban was 6.85% and 6% respectively. The CPI general for January 2024 was 5.1%, combined as against 6.52 in January 2023. The Reserve Bank of India on February 8 kept its consumer price index, that is CPI inflation forecast for the current financial year, that is FY24, unchanged at 5.4%. The central bank estimates the headline inflation for the next financial year at 4.5%. The decrease in February's CPI inflation rate is in line with the Reserve Bank of India's forecast, which projected CPI inflation to be at 5% in the current quarter before easing to 4% in July-September. The decline in inflation mainly attributed to easing food prices, with food price inflation at 5.9% in February compared to 6% in January. The RBI's latest forecast suggests that CPI inflation is expected to rise to 4.7% in the first quarter of 2025. However, the CPI, that is the Consumer Price Index, measuring changes in the average price level of goods and services consumed by Indians, significantly impacts the country's economy. High CPI leads to reduced purchasing power due to increased inflation, influencing interest rates set by the central bank, costs of living, business planning, and government policy decisions. Lower CPI, like the recent drop to 6.44% in February 2024, signals positive economic indicators regarding inflation control and its consequences on various sectors within the Indian economy. Now let's move further and talk about foreign exchange reserves. As of February 9, 2024, India's foreign exchange reserves dipped slightly by $5.24 billion to reach $617.23 billion. Prior to this, the reserves were at $622.5 billion as of February 2, 2024, and they had risen by $590 million to $616.73 billion as of January 26, 2024. India's foreign exchange reserves are influenced by a variety of factors, including intervention by the Reserve Bank of India to manage exchange rate volatility and support the Indian rupee. Changes in the value of foreign assets held in the reserves, such as the US dollar, also impact the size of the reserves. Valuation loss, robust FDI and FII inflows, trade deficit, central bank sales or purchases in the spot market, and geopolitical events can all contribute to the rise or fall of India's foreign exchange reserves. These factors interact dynamically to shape the trends observed in India's foreign exchange reserves. The Reserve Bank of India manages interventions in the foreign exchange market to maintain stability in the value of the Indian rupee. The Reserve Bank of India intervenes in the foreign exchange market to curb excess volatility in the rupee, and changes in foreign currency assets are caused by the RBI's intervention as well as appreciation or depreciation of foreign assets held in the reserves. Overall, the trend in India's foreign exchange reserves has been relatively stable, with some fluctuations in recent weeks. Now let's talk about the exchange rate. The USD was at rupees 82.9 as on 22nd February 2024, The rupee has marginally strengthened since a month ago. On 22nd January 2024, 1 USD was at rupees 83.1 and on 23rd January at rupees 83.22. GST. In January 2024, India's goods and services tax collections experienced a notable increase of 12% year over year to reach approximately 1.72 lakh crore. This represents a 10.74% year on year increase over January 2023. This is also the second highest collection of all times and only the third instance where collections have exceeded rupees 1.7 lakh crores in FY24. For the 10-month period this year, the cumulative GST collections till January 2024 has been rupees 16.69 lakh crores, a year-on-year increase of 11.6%. The increase occurred amidst global economic challenges, demonstrating the resilience of India's economy. The 11.6% YOY increase in India's collections for the first 10 months is a positive indicator of the country's economic growth and stability. All the large states in India have witnessed a significant jump in GST collections compared to the corresponding month last year. This indicates that the growth in GST collections is widespread across the country. GDP. India's GDP performance for the year till date reflects the culmination of various economic factors, shaping the country's overall economic health. The first official estimate for gross domestic product released in January 2024 pegged growth at 7.3% in the year through March, faster than the Reserve Bank of India's 7% projection. The Finance Ministry expects India to grow at or above 7% in fiscal year 2024 and another year of 7% growth in 2025. The Indian economy expanded 7.3% in the 2023-24 fiscal year ending in March, higher than 7.2% in the previous year, according to preliminary government estimates, with state spending on infrastructure projects offering a boost. The robustness seen in domestic demand, namely private consumption and investment, traces its origin to the reforms and measures implemented by the government over the last 10 years. The Indian economy is poised to become the world's third largest economy by 2027 with a gross domestic product of $5 trillion, according to the Finance Ministry. Overall, India's GDP growth has shown resilience and is expected to continue on a positive trajectory, supported by strong domestic demand and government spending. We have covered these in extensive detail in our video based on the economic review presented immediately before the interim budget. You will find the link to this video in the description. Interim Budget. The interim budget for 2024 to 25 was presented by Finance Minister Nirmala Sitharaman on February 1, 2024. The budget aims to strengthen India's economic foundation, focusing on capital expenditure, infrastructure development, and fiscal consolidation. The key announcements made in the budget include allocation of 11.1 trillion rupees for infrastructure, up 11.1 Y/Y. Increase in overall budget spending to rupees 47.66 trillion, 6.1% higher than the revised estimate. Reduction of the fiscal deficit target to 5.1% of GDP. Emphasis on education, health, and affordable housing programs. Continued efforts to improve rural livelihoods and reduce subsidies. Encouragement of private sector investments and foreign direct investment. The budget also includes a scheme to help the middle class living in rented houses to buy or build their own houses, tax benefits to startups, and investments made by sovereign wealth or pension funds extended by 1 year till March 31, 2025, and a hike in capital expenditure to rupees 11.11 lakh crore. The budget is being seen as an economic manifesto for Prime Minister Narendra Modi's ruling Bharatiya Janata Party, giving cues to the market on its plans for fiscal consolidation, borrowings, and future taxation policy. The budget reinforces the government's commitment to sustainable growth and inclusive development, with a focus on capital expenditure and fiscal prudence. The Monetary Policy Committee of the RBI met on 8th February 2024. Here are the major highlights from this meeting. The Monetary Policy Statement, resolution of the Monetary Policy Committee, that is MPC, refers to the formal document released by the Reserve Bank of India, detailing the committee's decisions regarding interest rates and monetary policy based on an evaluation of the current and future macroeconomic scenario. On February 8, 2024, the Monetary Policy Committee, MPC, of the Reserve Bank of India decided to keep the policy repo rate under the Liquidity Adjustment Facility unchanged at 6.5%. Along with the standing deposit facility rate at 6.25% and the marginal standing facility rate and the bank rate at 6.75%. The MPC also reiterated its focus on withdrawing accommodation to ensure that inflation progressively aligns with the target while supporting growth. These decisions are in line with the objective of achieving the medium-term target for consumer price index inflation of 4% within a band of plus minus 2% while supporting growth. Overall, the RBI's monetary policy stance remains accommodative, with a focus on maintaining price stability while supporting growth. While the RBI has kept the policy rates unchanged and the tone sounds accommodative, based on the extremely high credit deposit ratio at various banks, we do not expect the policy rates to fall at any time soon. That's all for our monthly update on the Indian economy for February 2024. We hope you found this video informative and insightful. Stay tuned for our next update, where we will continue to provide you with the latest economic developments and analysis. Don't forget to like and share this video with your friends and colleagues who are interested in the Indian economy. And as always, keep subscribing to our channel for more engaging content. Thank you for watching, and we'll see you in the next one.